Trading Family, Monday morning, June 29th. Let's talk about what changed while you were sleeping. Because overnight, we got two supply shocks hitting the same open. Iran struck Bahrain and Kuwait, and China blacklisted 20 Japanese entities. Oil is gapping. Tokyo is flat to slightly green, and my paper account is flat cash, waiting to see how this shakes out. TB, take it away.
Quick disclaimer, nothing we say is financial advice. Do your own research. That said, here's the tape. S&P futures are down. The Qs are pre-market around $704.94, down 1.6% from Friday's close. VIX at 18.37. Overnight oil is not gapping into the mid-70s. West Texas Intermediate crude is actually around $70.07, up just over 1%, and Tokyo opened flat to slightly green. Nikkei 225 closed up 0.15%. The tension this morning is whether the market can separate two independent shocks, Iran threatening Hormuz transit and China weaponizing rare earths, or whether everything just gets bundled as risk-off.
That separation angle is the whole show, TV, because right now I don't think the market's separating anything. It's just red and selling. Let me start with Iran, because this is the biggest story. Over the weekend, Iran directly struck Bahrain and Kuwait, not proxies, not a message sent through Hezbollah. Direct ballistic missile strikes on two U.S. allies in the Gulf. This is the first time since the conflict started in February that it's expanded beyond the Israel-Iran axis, and it completely rewires the oil math. The template everyone's reaching for is January 2020. Soleimani. Iran launched missiles at U.S. bases in Iraq. Oil spiked 4%, then both sides blinked. Oil crashed 10% the next day. Spike, fade, done. That's what the market wants to price, that this is a 2020 rerun, and oil will gap, then fade. But 2026 is not 2020. In 2020, the U.S. Strategic Petroleum Reserve had 600 million barrels. When oil spiked, the administration could say, "We're releasing 50 million barrels. Calm down." That was a credible cap. That credibility is gone. The SPR has been drawn below 400 million barrels. The shock absorber is thinner. So even if the geopolitical pattern holds, and that's a big if, the fade is shallower. Oil at $70 is about to gap to maybe 74, 75. If it fades to 72, not 68. And then the market realizes there's no safety net and drifts right back towards 78 by week's end. My personal lesson from the last trade. I got stopped out of the energy sector. ETF on the peace deal, unwind. Thesis was right, timing wrong. Took a 5% loss on thesis death. So this morning, I'm waiting. Cash is a position. You do not chase the first print on a Monday with Iran live. Let the gap open. Watch the candle structure. See if the 72 to 75 zone holds.
That SPR point is crucial. The fade is mechanically shallower because the administration can't credibly cap a spike. And there's a second piece the market hasn't connected. China blacklisted Japanese entities overnight. Let's get into that because Tokyo opened red under the hood even though the Nikkei headline is flat. Sunday night, China named 20 specific Japanese entities: Mitsubishi Heavy Industries, Mitsubishi Electric, Mitsui Engineering and Shipbuilding, plus 4 defense research institutes, all barred from receiving Chinese dual-use items, which includes rare earth minerals. This is a direct escalation of the January campaign that followed Prime Minister Takaichi's Taiwan comments. They're not sanctioning categories anymore. They're naming corporate units. That's enforceable with a paper trail. For U.S. markets, this hits semis with Japan exposure. My wave trader AVGO has MRVL down 12% from a $326 entry, and FORM, form factor, down 14.7% from a $156 entry. Those aren't random drawdowns. MRVL runs custom ASIC partnerships through the Japan-Taiwan supply triangle. Form factor makes testing equipment for Japanese fabs. Both are directly in the path of this export control expansion. The system keeps stops wide. 222 on MRVL, 106 on form factor, so they're not at risk of being stopped today, but those are real wounds. The market wants to bundle this with Iran as risk-off, but they're two separate supply shocks. One threatens oil transit, the other restricts rare earth and dual-use tech. They feed the same sector rotation, but through completely different mechanisms. The edge is that nobody's separating them yet.
That's the double punch. Tech semis are catching both ends. Iran hits risk appetite, and the China-Japan curbs hit specific supply chain names. Together, they explain why the Qs are at $704 pre-market. But the rotation underneath is bigger than this morning's news. TB, take us into the macro picture and Warsh, because Spanish inflation printed hot today, and Warsh speaks in a holiday-shortened week. That's where the real driver is.
Right. This morning, Spanish CPI came in above expectations, stubbornly above the European Central Bank's 2% target. That's not an isolated data point. It sits right next to last week's U.S. core PCE at a 3-year high, and Elizabeth Warren directly blaming tariffs for business uncertainty. We're in a correlated global inflation regime. It's not just a U.S. problem, not just a European problem, it's both. What does that mean? The ECB can't signal a rate cut. The Fed can't signal a rate cut. And Warsh is speaking this week in a holiday-shortened week. Thursday is a half session, Friday is Independence Day closed. Liquidity conditions are thin. Any policy mistake, any word that sounds dovish or more hawkish than expected, gets amplified with no time to absorb it. Here's the bond market play. Big money, BlackRock, PIMCO, DoubleLine is buying the belly of the curve, the 5 to 10-year maturities, and shorting the long end, the 30-year. That's a bet on fiscal discipline and slower long-term growth under Warsh. If he stays hawkish, that flattening trade pays. If he sounds even slightly dovish, the position gets squeezed and yields rip lower. This positioning matches exactly what we're seeing in equities. Capital moving out of Qs into XLV, out of tech into healthcare. Selling the Qs and buying healthcare is the same macro call as selling TLT and buying ETH. It's a bet that rates stay higher for longer and that growth slows. The reason oil can't just crash back to $68 like 2020 is the same reason. In 2020, the Fed could cut rates to absorb an oil spike. Now they can't, because inflation is running at 3.5% and showing no signs of easing. So energy prices carry a risk premium that reflects central bank paralysis.
So the bond market is front-running a hawkish Warsh, and the equity market is front-running a defensive rotation. Same trade, different instruments, and the timing makes it more dangerous. Any hawkish message hits in thin liquidity Thursday, and then we sit through a 96-hour weekend blackout without being able to adjust. That naturally pushes positioning toward defense. Okay, TV, let's hit the segments fast. Earnings first. What do we have?
Earnings calendar is not empty. 12 reports today, June 29, including AVGO and CNXC after hours, and 26 tomorrow, including Nike, STZ, PRGS. Plain and simple. The story is macro and geopolitics, not corporate fundamentals. Moving on the economic calendar, everything hits Wednesday. The main events, German national CPI, consensus 2.5% year-on-year, prior 2.6. A beat above 2.5 would reinforce the global sticky inflation narrative and harden the ECB trap trade. US JOLTS job openings. Consensus 7.28 million, down from 7.618 million, a cooling labor market signal. US consumer confidence expected at 94.2, up from 93.1, modest bounce. And Japan's Tankan Big Manufacturing Outlook Index, consensus 13, down from 14. A dip is expected, but watch capital expenditure plans. All that drops Wednesday morning, U.S. time, in a thin pre-holiday session where reactions get amplified.
German CPI is the sleeper. If it prints hot, it confirms that inflation isn't just a U.S. story, and it tightens the no-cut for UVice on both the ECB and the Fed. That further cements the defensive rotation. And speaking of rotation, TB, paint the sector board, because what's happening is a regime shift, not a flinch.
1 week performance. Leaders, Healthcare Select Sector SPDR, XLV, up 7.32%. Utilities, XLU, up 3.2%. Real Estate, XLRE, up 3.15%. Laggards, Consumer Discretionary, XLY, down 2.38%. Communication Services, XLC, down 2.9%. Technology, the tech sector, down 5.4%. That is not a flinch. That is capital moving in size. The money that was in tech last week is now sitting in healthcare. With oil rising and supply chain risks widening from China's export curbs, defensive positioning is the default. If Warsh stays hawkish, this rotation deepens. Historically, it does.
Exactly. Healthcare becomes the default parking spot because it has pricing power on supplies, demographic tailwinds, and it doesn't care about dual-use trade restrictions or Strait of Hormuz choke points. That's where the safe money is going. Now, TV, connect the international plumbing. How Asia and Europe traded overnight, and what it means for U.S. names.
Asia overnight. Nikkei 225 flat at plus 0.15%. But under the hood, the China-Japan sell-off is concentrated in defense and Japan-exposed semis. Hang Seng up 1.57%, Shanghai Composite up 1.16%. Chinese markets aren't pricing their own rare earth weaponization. Kospi down 0.2%. Europe is quiet, DAX up a fraction, FTSE's down a fraction, Eurostoxx 50 flat, all waiting for the US lead. In FX, dollar-yen is up 0.07%. Yen not screaming, so carry trade unwind risk is contained but must be watched if Japan tensions escalate. The dollar index is down a touch, normally supportive for risk assets, but not today. The connection to US names is direct. The China-Japan rare earth restriction tightens the supply chain for semiconductor equipment and custom ASIC firms. MRVL, form factor, and any stock touching Japanese defense or industrial supply chains are under direct pressure. The Tokyo price action is the canary. Watch the Nikkei open Tuesday to see if the selling spreads beyond the blacklisted entities.
That Nikkei open is one of our 4 things to watch tomorrow, by the way. I'll get to that in the close. But first, let's get into portfolio hot news, the theme driving our book. Because we're both sitting in real wounds this morning, and I want to put them on the table. Here's the thread. 2 independent supply shocks, Iran oil and China rare earths, are accelerating a defensive rotation that was already underway. The bull case, the shocks are separable. Iran de-escalates. Oil fades to 72. Japan-specific damage stays contained. Rotation pauses. The bear case, Iran hits a Saudi facility or a U.S. Navy ship. Oil goes to 90 in 2 weeks. China expands the blacklist to Taiwan. Linked firms, semis go into supply squeeze globally, and defense. Energy and healthcare become the only trades that work while tech bleeds. My TFT algo is holding Broadcom, with a stale stop at $446, while the price is now $370. That's $113 of unrealized loss per share. That's not a system failure. That's a risk management error on my part. I should have tightened the bracket, and I'm owning it on air. AMD and ASML are holding, but the Broadcom wound is real. My personal paper account is flat cash. I screened 3018 signals. Friday, 0 cleared the gate. Prospective gain below 5, EMA gate failures, ATR % blowouts. The engine is working. It's just not finding anything it trusts. Your side, TB, MRVL and form bleeding, but you're not averaging down either.
That's correct. The wave trader algo won't average down because the EMA gates are failing. And that's the system correctly reading that the short-term setup is poisoned by trade policy. MRVL down 12%, form down 14.7%. Stops are wide enough to survive the drawdown, but I'm not adding. My personal paper is also flat cash, same screening result. 18 empty slots. Cash is a position. When 2 independent shocks hit the same open, patience beats heroism. The market will separate them eventually. Wait for that separation before committing. Second order effects, the oil floor structurally moves up because the SPR can't blunt spikes like 2020. Even if de-escalation returns, crude settles $4 to $5 higher than the 2020 template suggests. Rare earth supply constraints benefit non-China producers like MP Materials and Lynas, and accelerate onshoring by U.S. allies. And a hawkish Warsh solidifies the bond belly trade and pushes more equity capital into defensives.
So the takeaway for listeners is, cash is a position, 2 shocks at once. The market hasn't separated them, and you don't have to be a hero this morning. Let the tape prove which one matters more. All right, let's close with what we're watching tomorrow. 4 things. First, Q's at $700. That's the line in the sand. If it holds, we could get a Wednesday bounce trade. If it breaks, the door opens to full defense. Second, oil settlement range. 72 to 75 needs to prove itself as the new floor. Watch for any SPR headline or Hormuz signal. Third, the Nikkei open Tuesday. Will the China-Japan selling widen beyond the blacklisted names? That sets the tone for U.S. semis. Fourth, any pre-speech Fed comments or leaks ahead of Warsh, since the thin tape magnifies everything.
Stay disciplined, filter carefully. Q700 is all that matters until that resolves.
Diamond hands on conviction, paper hands on risk. Know the difference. I'm Wildcard. He's TB, and we'll see you tomorrow with the tape.